Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Good morning, everyone. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling following the latest read on the economy with PPI and retail sales. Those prices paid to U.S. producers unexpectedly declining in April by the most in 5 years, reflecting a slump in margins, suggesting companies are absorbing some of the hit from higher tariffs. Meantime, retail sales largely flat month over month. Investors also digesting commentary from the Fed chair as Powell says we may be entering a period of more frequent and potentially more persistent supply shocks.
Plus, Walmart out with earnings and warning price hikes are ahead. Shares flat after the company delivered solid sales and earnings growth. The retail giant is bracing for a bigger hit from the trade war and overall economic slowdown in the coming months, citing a lack of clarity in the current operating environment.
And Dick's Sporting Goods announcing a $2.4 billion deal to buy Foot Locker. Dick's is expecting to operate Foot Locker as a standalone business unit and maintain the Foot Locker brand as well. The deal expected to deliver $100 million to $125 million in cost synergies, but could attract regulatory scrutiny due to Dick's dominance. Both companies currently grappling with the impacts of President Trump's tariff plans. Investors digesting a fresh round of economic data this morning. Wholesale inflation unexpectedly contracted 0.5% during the month of April, reflecting a slump in margins, suggesting companies could be absorbing some of the hit from higher tariffs. That inflation reading coming as retail sales for the month were largely flat. Michael Darda, Roth Capital Partners chief economist and macro strategist, is here to break it down. Michael, great to have you on here to make sense of this for us. It feels like PPI is the star of the movie this morning here. Talk to me about what it means for consumers and for companies.
Absolutely. Thank you for having me on. Not much pipeline inflationary pressure, at least so far. And we also had a good CPI reading that was quite calm for April. So, I think there's a little bit of uncertainty here in terms of if this is just temporary before the tariffs start to hit. We think there's going to be some upward pressure from the tariffs, but critically, if these numbers were well behaved going into the tariff storm, I think that'll give the Federal Reserve a lot more confidence that in the event that they need to support the economy with a lower policy rate, they'll be able to do so. Now, President Trump has backed off some of the most aggressive proposed tariff increases, particularly on China. So at the margin, that helps as well. If the tariff shock is less intense, the economy is less disrupted, then there'll be less of a need for the Fed to potentially support growth. So all of that has played out, obviously, in very buoyant financial markets. And, today we're getting a bit of a pullback, but it's been one heck of a run over the last month.
Michael, with that in mind, and that key point that you made a moment ago, and that there was the chaos up front and then the kind of quick about face once the market started to scratch or be in the area of bear market territory. And it was like, okay, wait a minute. We don't want that on our hands. We're also hearing from some of the company CEOs about shelves not being able to be stocked later on. So we need to back off, as you were mentioning, step off of some of the more harsh tariffs and continue to figure out what negotiations can net out in the details here. So what is the likelihood that we would see, and how so would we see the tariff impact actually flow through to some of these numbers if companies are saying, hey, just keep that vessel out there for as long as you can until we hear some of the walk back?
Yeah, exactly. A lot of good points there. I mean, I guess we figured out where the Trump put is. Coming into the year, markets were overly optimistic that the whole tariff bluster was just that, a bluff. And then the Liberation Day tariff proposals were so much more aggressive than what the market had anticipated. That threw us into a bit of a tailspin. And at least initially, it didn't really look like the administration was going to react to financial market upheaval. And then they eventually did, I think, when the bond market started to shoot yields higher, even with risk assets falling, which was kind of a scary moment in early April. That's not the typical association configuration that you would see. The administration has softened and backed off, and that certainly helped things. Now, look, I mean, the average effective tariff rate is going to still be rising pretty dramatically from where we were before we came into this year. It's just not going to be as extreme. So we still will see a disruption in the business cycle. We'll see some pressure on inflation, but the key is, if that's going to be temporary and less extreme, then risk markets don't have to price in the recession probabilities going above 50%, which was the case coming into April.
How does this impact profit margins going forward? And I ask you that in the context of some commentary we're getting in from Fed Chair Jerome Powell talking about how supply shocks could be consistent. And then within this PPI print, you have a proxy number for profit margins easing in April. That's good for consumers, but bad for profits, and maybe in part why we're seeing a little bit more pressure on the stock market right now. How do you weigh the impact of supply shocks and potential profit margin concerns when you're thinking about earnings growth going forward?
Oh, for sure. Yeah, I think, the tariffs are definitely going to at least cause a temporary period of weakness for corporate earnings. The question is, how severe that is and how long it lasts. The good news is that we've seen very moderate wage growth consistent with price stability. And so I mentioned before, I mean, that puts the Fed in a very good position if they do need to respond to economic weakness. And markets really priced this in real time. We had almost a 19% decline in the S&P 500 from peak levels February to early April. And so the market, we had analysts expecting 14% earnings growth, and the market obviously priced that out pretty rapidly. In this rebound until today, I think, is a reflection of an expectation that, yes, temporarily it will disrupt the economy and earnings, but that won't be long lasting. So we'll see whether it plays out that optimistically. On the productivity side, we've been getting some good numbers until the most recent reading, which I think was a bit of a distortion. So if the AI story can continue to play out and we have relatively good productivity statistics going forward, that long-term will help corporate profitability. But there's no doubt that we're going through a period of uncertainty and disruption here.
Michael, good to see you this morning. Thanks so much for taking some time ahead of the opening bell.
My pleasure.
Stock futures falling this morning as the stock rally loses momentum. Weakening data and warnings from the Fed weighing on investor sentiment. And our next guest says, you don't want to buy the dip. Joining us now, we've got Alex Morris, FM Investments CEO and CIO. Alex, good to have you here in studio.
Good to be here.
So take us through why you don't want to buy the dip, especially given the run back that we've seen off of the lows of potentially the lows of the dip.
Well, low so far, right?
Yes.
And I think the reason why we don't like buying these moments are there's no certainty, right? Every time we hear of a new plan, it's another 90-day plan. And there's a whole patchwork of these going together, but eventually markets are going to call the administration to task and say, we need to know what's going on.
You don't think that's already happened?
Well, I think they made very clear what they felt about tariffs, and we saw some reprieve, but I haven't seen any policy come through. We haven't seen anything passed by Congress. All we've seen is a handful of, we'll kick the can down the road. We saw a plan from the UK that is not a model for anybody else, but I think what markets did like was they were heard. And the concern coming into April was Donald Trump wasn't going to listen to the stock market, he wasn't going to listen to the bond market, and he wasn't going to listen to his own cabinet. Well, we learned that he will, which was a good thing, but we've yet to really see anything permanent, and I think markets are going to want to see that before they start to take off. There's going to be some bounce right now, but I think we're going to see a lot more volatility ahead. It's nice while the president's getting airplanes and feted with camels that look like they're a scene out of Disney's Aladdin. It's another thing when that stops, and that will have to stop at some point.
So it sounds like you don't believe in a Trump put until you see final policy on the table, which I understand. But what should investors do with that framework then? Do they sell into this rally to get into cash? What is the play off of that?
We still like cash on the short end. We think you're still earning 4%. Those numbers are going to come up. We do think there's going to be some opportunities at the longer end of the curve soon when those, right now the 30-year is trading about 5, the 10-year about 4.5. We think those numbers probably another 50 basis points on the way up, and then we'll start to come back down as the Fed will have opportunities to cut later in the year. But right now, it's choose your asset allocation and stay put. Don't try to time this market, because as we saw in April, if you were getting a cup of coffee, you missed 10% of a market rally. And it's very hard to try to buy into these moments when they're going to take milliseconds to play out, not days or weeks.
What do you make of the health of corporate balance sheets right now, navigating through this as we've essentially made it through the bulk of earnings season here? And mind you, we have two CFOs sitting in the green room right now, so they're going to be listening closely to what you're saying.
Yeah, they'll give me my report card afterwards.
Exactly. So what are you making in the profiles of what we're hearing from companies this earnings season and how they're navigating this period?
I mean, certainly it seems that cash flows have been strong. The consumer is still present, but I think we're hearing that may stop. Whether it's supply shocks, which the American consumer is spoiled in the sense that in 2 clicks in 4 hours, usually, I can have just about anything I want anywhere in the world show up to my door. That seems like that's going to come to an end somewhat. But we've heard it last earnings seasons a little bit. We're really hearing it now. Uncertainty. And that's the problem, is when you're uncertain, you can't make capital allocation decisions. You can't decide what to buy, what not to buy, what plans to make. And markets can accept that for a short while. They really don't like that for a long period of time, and they're going to start demanding some certainty.
And I wonder, too, how that is going to impact consumer sentiment and therefore consumer spending. I was just talking about that PPI data indicating some pressure on profit margins going forward here. We had Walmart talking about prices increasing as soon as this coming month, which was earlier than anticipated. How are you thinking about how that could impact earnings growth going forward?
Certainly, consumer sentiment in general is going to start to come through the polls, which is where politicians are really going to start to care. They're having trouble passing a tax bill, which is difficult all to itself. But in the long run, I think the consumer is happy as long as they don't have to pay for the tariffs. Right now, that isn't happening. Amazon famously didn't or did say they were going to put the cost of tariffs and then pulled that back instantaneously when the White House was upset. But eventually those will have to make it through to the end consumer. A 10% or 30% tariff is a national sales tax in large regard, and everyone will have to pay it.
Just lastly here, we only got about 30 seconds here. For those who are trying to think about their portfolio strategy and making sure that they're not fighting the Fed, even though the Fed is kind of just staying on its same course of action here, how should that be kind of playing out in their own strategy?
So we launched a product to help folks do that. We call RBIL, RBIL, because you can't fight inflation. Jerome Powell can fight inflation, Donald Trump can fight inflation, we can just participate in it. So now here's a way for investors to sit at the short end of the curve in the tips market without any duration and follow inflation up and down in a cash protected way. And then when they see the opportunity to flip into risk assets, you can get right out and ride the S&P 500, I hope, back to new highs.
All right, Alex, thank you so much. Great overview for our audience. Really appreciate it, as always. We are going to get a check on shares of Walmart at the moment coming up on our screen here. If we can take a look, Walmart again posting those stronger than expected sales, but warning about prices coming forward, also pulling their second quarter operating income guidance here. The shares down a little over 0.5%. One of the key things that I am monitoring is the company coming forward and saying, hey, we're actually going to raise prices sooner than we originally told you guys. Those price increases are going to come as soon as next month. And one of my questions on that I'll be asking the CFO when he comes on our air in just about a half hour here is to what extent any trade negotiations have given Walmart a green light to be able to pass these costs on to consumers, because 145% tariff is very different than a 30% one. So at what point does Walmart say, hey, not only are we going to pass this cost on to consumers, but maybe we're going to spread it across the board and increase the prices more broadly to kind of disperse the impact?
Yeah, absolutely. Great question. Another point that could be brought up, at least in the conversations, any sort of addressing that we see coming from the likes of Dick's and Foot Locker here. This is another one. I'm keeping an eye on shares of Dick's and Foot Locker here. Pre-market, you're taking a look at Foot Locker jumping by 83%, Dick's lower by 11%. Here's the deal. In a press release issued today, Foot Locker, Dick's Sporting Goods announced they've entered into a definitive merger agreement. Dick's going to be acquiring Foot Locker, $2.4 billion price tag on this deal, enterprise value of approximately $2.5 billion. And then additionally here, the deal is expected to close in the second half of 2025 here. This is a major tie-up among two retailers that have a lot to do with making sure your feet stay comfortable. We've got all your market action straight ahead. Stay tuned. You're watching Morning Brief. Now time for some of today's trending tickers. We are watching UnitedHealth, Apple, and CoreWeave. First up, UnitedHealth under investigation for possible criminal Medicare fraud, according to a report from the Wall Street Journal. The Justice Department is focusing in on the company's Medicare Advantage business practices. This adds to other investigations into UnitedHealth, including potential antitrust violation. You're taking a look at shares right now, moving lower by about 8.3%. It's been a bad week, no good, can't get up type of week for UNH shares, as we saw the stock dip earlier this week on the announcements from the company, both financials and C-suite shakeup.
Right, exactly. This comes, of course, after the company announced the departure of its CEO, Andrew Whitty, due to personal reasons, also suspended their full-year guidance, the latest company to do that. And we should also mention this investigation from the Justice Department has been ongoing since last summer, according to the Wall Street Journal reporting. So something that we will certainly continue to cover as we get more information about that investigation. But next up, let's talk about Apple. President Trump pushing the iPhone maker to stop building plants in India, telling CEO Tim Cook to increase production in America. Apple assembled $22 billion worth of iPhones in India in the 12 months ending in March, up nearly 60% from a year earlier. This is the perfect example of the administration putting these companies in a bit of a tough spot because they want to avoid tariff policy. They move production to India, but then you might get called out by the president in a presser and Q&A from the White House as well.
Yeah, slack-jawed I am right now, and here's why. Number one, file folder, not going to happen. They need India, and India also wants them to produce more within that region in order to sell directly into that consumer. So that's one thing. But two things can be true at the same time. Apple can also ramp up production here, but it doesn't have to be on the iPhone, which is the bread and butter of its business. It could be other products. It's just a matter of how and over what time frame, because Apple can put forward a dollar figure, but then say, okay, yeah, we'll take 10 years to put that into action. That's one of the ways that we've seen companies making their vows or their commitments to the administration, but at the same time saying, oh, you know, we need some time to put billions of dollars into action on these things.
And we had Dan Ives saying if they produce in the U.S., the iPhone could be $3,500.
I don't want to pay $3,500 for an iPhone.
Nobody does.
I'm sorry. Finally here, CoreWeave's revenue soaring more than 400% in its first earnings report since going public here. The company announcing higher than expected capital expenditure plans, expecting $20 billion to $23 billion for the year. Shares of CoreWeave, hey, nice little reception. They're up by about 1.92%.
This has been an interesting one because I broke the earnings on this last evening on the show, and we saw a pop in the stock up as much as 6%. Then they announced their debt load, didn't like that. So then we saw the stock declining by as much as 9%, and now we've got a bit of a recovery today. We're going to continue to monitor moves with CoreWeave. Again, that revenue coming in better than the street's expectations, but the debt load, that is a question, especially as interest rates are expected to remain a bit higher for longer. For our audience watching, you can scan the QR code below to track the best and worst performing stocks with our trending tickers page. Let's talk about Cisco. The stock up nearly 3% after topping third quarter expectations, revenue increasing 11% from a year prior. The company also announcing a change of leadership with CFO Scott Herren planning to retire in July. Current Chief Strategy Officer Mark Patterson will take over as the new CFO. Here with us now, Scott Herren, Cisco's outgoing CFO, and Mark Patterson, Cisco's incoming CFO. Thank you both for being here. Certainly a lot to talk about, but Scott, I want to start with you on the quarter here. Walk us through the numbers and how you got there.
Yeah, thanks, and it's always good to see you both again. Thanks for having us in, and it's great to see Mark sitting across the table.
Good to be here.
It was a good quarter. It was strong across the board. We had good, positive product bookings growth, and of course revenue growth across all three geos, across our customer segments, and across our product lines. So we had good, balanced worldwide growth on the top line. Bottom line came in well ahead of expectations. We were actually above our guidance range on both revenue and about 4 pennies above on the bottom line. So the profitability came through as well.
And Mark, as we think about the torch being passed, you're going to be kind of stewarding this company through this iteration, this next wave of the AI opportunity, which we know Chuck has talked about being a strong opportunity for the business here. And CapEx continues to come into mind for a lot of investors. That seemed to be what's on all of the grading cards over this report. As you think about that going forward here, what does that profile look like for Cisco? How much are you spenders into that opportunity?
So first off, congratulations to Scott. He certainly had a big impact on Cisco and been a great partner for me for many years. I've been with Cisco now 25 years. And it's a bit of a homecoming for me. I came into finance and have spent time in finance strategy, operations, the sales organization, et cetera. But I would tell you, in 25 years, I don't know that I've ever been more optimistic about sort of where we're headed in terms of what we can control. If you look at our key markets, if you look at the progress that we are demonstrating in AI and the criticality of our technology in that space, over $600 million worth of orders in Q3 alone. We're pretty excited about that. We're also very excited about what we're doing in cybersecurity, and the acquisition that we made there with Splunk is playing out very, very well. But there's a lot of uncertainty, certainly, in the economy and with what's going on in tariffs, et cetera. So we'll look to the near future and see how we resolve those things.
I do want to talk a little bit more about your tenure, but first I want to get a question to you, Scott, on the quarter here, and something that I keep hearing from analysts is the focus on customer modernization. This is a key focus for you, I know, as well. How would you define that? Because I hear a unique definition from the analysts I talk to, and how is that effort going to modernize your customers?
Well, hopefully, despite perhaps different vocabulary, we're all talking about the same trend, and what it is obviously AI is, and in particular, Gen AI, right? AI has been around for a long time, generative AI. And if you think about that, what's kind of groundbreaking about it is it's a dialogue. It's a back and forth. It's not a send a question, get an answer, right? And with that capability, as you can imagine, that drives more traffic on the network. So what we see from our customers, in particular our largest customers, is they're 18 to 24 months into their own, how are we going to use AI to make our company more productive and to drive efficiencies in the company, and those things are starting to bear fruit, and they said, okay, now as this goes broad across sales, across marketing, across finance, I've got several AI projects in my team. Right. That's going to drive a lot more traffic, and while I'm in this mode of having my AI project scale up, I need to make sure my network is ready to be able to handle that increased traffic. And so we see a lot of our larger customers coming in and buying what everybody buys from Cisco. They're buying switches and routers and access points and security from us. When you ask them why are they doing that, they're saying it's in advance of AI projects going much more broadly across my company.
With that in mind, and just to follow on that real quick, so as we're seeing more scaling around these projects, it's been a focal point, at least while the president is traveling, to get some of these deals, to build out data centers, to build out more infrastructure, but not necessarily fully here in the US, looking at some of the international partners, building out data centers in the Middle East, for instance, even. Is that something that you see as a continuation trend? And why is that? Why is that the focal point right now, looking to some of those international partners to bring on that infrastructure?
Yeah, we absolutely see that. And in fact, part of what we announced earlier this week, besides a great set of earnings and some nice business momentum, is 3 specific partnerships that we launched all in the Middle East, between Saudi Arabia and the UAE, around the build out of infrastructure there. And whether it's talking to the leaders of the UAE or talking to the leaders in Saudi Arabia, they all see the same trend that, we've got energy, but the fossil fuel energy trend at some point is going to begin to taper. What's the next thing that's going to drive our economy and going to keep the people in those countries gainfully employed? And they're all looking at AI. So I think you could end up seeing, obviously, the United States as a center for AI. China will continue to be a center for AI. I think the Middle East will be a center for AI as well. And so our partnerships there are really targeted at, as that infrastructure gets built, we want to be helping architect what that looks like, and then, of course, providing the networking infrastructure that drives it.
So, Scott, Mark, I want to follow up with you on this, because as Scott laid out these deals with the Saudis, you are going to be the one at the helm when these financial commitments come to your balance sheet. I was talking to a tech analyst yesterday. He told me to take all of these deals with a grain of salt, because companies want to curry favor with this administration. They might be keen to announce investments, and then maybe a couple quarters from now, you dial it back a little bit. How firm are you on this commitment to this deal with the Saudis? Is it something that benefits you as a financial part of the company, or is it a strategy with this administration?
Yeah, that's a great question. So we're very committed to this. The early progress that you've seen us post in this AI infrastructure space has been primarily with US-based, web scalers, certainly. We see this as a huge opportunity, and I think that the Saudis are going to spend, and they're going to spend quickly in terms of really advancing AI within the region there. And so, I think that the selection of Cisco, if you think about it, they look at us as being able to really design, integrate, and secure AI infrastructure in the space. And so our portfolio is a very broad portfolio and has a lot to offer in terms of what they're trying to accomplish.
What are you seeing from deal cycles right now?
I think that we actually, while you'd expect maybe a bit of a pause given what's going on in the economy, we actually had a very strong, robust quarter. If you look at it across customer markets, you look at it across geographies, et cetera, it's actually been very, very good, very stable, very balanced around the globe. And so certainly we're focused on what we can control, and things can change, but right now we feel pretty good.
Scott, I got to end with you. Only about 30 seconds left, but why the retirement? Why now? You'll remember a lot of CFOs retiring during the pandemic. Is this the start of CFOs retiring during the trade war?
I wouldn't think that I'm leading the CFO parade out the door. It's time. It's the right time for me. In my life, we've built an incredible amount of business momentum at Cisco. We've accomplished the things that I really wanted to accomplish when I took this role almost 5 years ago. If those things weren't all in place, if we didn't have business momentum, I've got an incredibly strong finance team that Mark will get a chance to lead. I can't wait to see him put his own mark on Cisco, but for me, it's just the right time to go.
I think he just wants to beat me in golf, even more than he already does. I mean, it's like
that's fairly unlikely. By the way.
I don't stand a chance.
Scott and Mark, thanks so much for taking the time here with us today. We'll let you get back to watching the PGA Championship. We know it's the first day.
Thank you. Thank you both.
Thank you.
Coming up, it's the opening bell on Wall Street when Morning Brief returns.
That's your opening bell on Wall Street. Taking a look at live images from the New York Stock Exchange and the NASDAQ. You've got eToro there following their initial public offering on Wednesday. But let's do a quick check on the markets here. Taking a look at the major averages here. You've got your S&P 500 under a bit of pressure, down about 0.4%. Your tech-heavy NASDAQ down about 0.7%, snapping 6 days of gains here. When you zoom out a little bit, you see a prettier picture here on the tech-heavy NASDAQ, up about 6% over the course of the week. But stocks broadly under a bit of pressure, giving back some of the gains that we have seen this week. And also, we can't overemphasize enough that producer prices number coming in below expectations, indicating that while companies may be taking it on the chin when it comes to passing on those tariff costs to consumers, there could be pressure on profit margins to come going forward, and you're seeing that reflected in the price action this morning here, Brad.
All right, thanks so much. One stock that we are watching at the open, Walmart. Walmart's CEO warning of price hikes on the earnings call, saying higher tariffs will result in higher prices. Walmart declined to give profit guidance for the second quarter after reporting mixed results for Q1. Joining us now, we've got good friend of the show, Oliver Chen, TD Cowen Senior Research Analyst here. Oliver, good to see you. Just take us into your assessment here of what you saw and heard from Walmart.
Hey, Brad, great being here. We continue to be excited about Walmart. It's a top 3 idea for us. They're managing well in a very difficult environment. And specifically, they're going to hold food prices as much as they can, but they're going to prioritize in terms of managing these tariffs and offering the consumer value. They will have to raise some prices based on the feedback today, but overall, it was a really solid quarter with upside on the revenue line. Gross margins a little bit lighter than we expected, but that was more than made up by SG&A. And they reiterated full-year guidance in a tough environment. That being said, for next quarter, they only spoke to top-line revenue guidance. Margins will be very volatile, and they know, and they said, the quarters will be volatile. As we zoom back, as you know, Brad, this is a story of and retail for us. It's and retail because it's value and grocery plus technology. It's middle and low income consumers, plus they're getting higher household income consumers. And they're a leader in everyday low prices in food. That will continue to be true and really benefits them in this tough environment.
The stock, Oliver, though, down about nearly 5% here. I wonder to what degree that price action is about the company indicating they're going to raise prices sooner than previously put forward, as soon as next month. How surprised were you by that?
Well, it's been so difficult, and Walmart is going to really be the leader in terms of holding prices as low as possible. So a lot of their articulation here doesn't surprise me in terms of what they're seeing, but keep in mind they're one of the best positioned retailers in terms of their leverage with suppliers, as well as supply chain, as well as the history of this company from Sam is everyday low prices. So we see them as very well positioned in this environment. but consumers will feel this pain, and there's a lot of volatility. So I think they're doing a great job managing amidst this unprecedented situation. And the real pressure here will likely be in food a little bit too in terms of the pricing.
You know, it's really interesting because staples are one of the areas and companies who are really representing that staples trade like a Walmart. When we do see any type of kind of economic or geopolitical skirmish even that could lead to economic pain, Walmart shares typically get leaned into. How are you assessing perhaps the unwind if we do see more of a risk on move and some of the investors out there, larger institutions, perhaps getting a little bit more appetite to include risk back in the portfolio?
Yeah, Brad, in terms of thinking about that, we have a hold rating on Target, but it has a very discretionary portfolio, 50% plus. You compare that against Walmart, which is 60% grocery. So you're right. In terms of appetite for risk, and if things get better and we don't have a recession, you're going to look at retailers like Target. We have buy ratings on stocks like Revolve as well as Warby Parker. Those are opportunities to watch too. And another idea we have is Bath and Body Works. So balancing the two. That being said, taking us back to Walmart, Walmart has general merchandise, a marketplace model, digital advertising, and technology, as well as food and grocery. So it's and retail, and that they're a need plus a want retailer. Costco also has great discretionary too. So these retailers should be both defensive and offensive, particularly with what Walmart's doing on the marketplace, which unleashes a lot of better brands, beauty, technology, some luxury goods as well. So we like that characteristic. Our top idea this year is BJ's Wholesale. Keep in mind that we're very excited about the wholesale channel in general. That should benefit BJ's. Sam's Club had great results today, and so did Costco. And those business models are also very focused on everyday low prices.
I am curious, you mentioned Target in there, and we continue to have this idea that Walmart and Target are these two big competitors. Do we need to throw that out at this point? Are they each other's biggest competitor?
Yeah, Madison, I'd say that they differ in that Walmart's such a grocery food leader and a pioneer in organic. At Target, there's a lot of discretionary. It's very exposed to home and toys, but they're both highly scaled retailers with tremendous reach. I would say that Target bringing joy, private label, Target Circle a little bit earlier in the journey. They do compete because they both have such big importance to U.S. customers at large. But as you think about Walmart, it's very advanced grocer. As you think about Target, it's very good at home discretionary apparel. Food's about 20% analytically, and food's about 60% at Walmart.
You know, Oliver, while we have you here, big news this morning. Dick's, Foot Locker, I don't know who had this on their bingo card for 2025, but it's happening for $2.4 billion here. As you're thinking about tie-ups in the retail space more broadly, what is this signal? Because now we're thinking about two major kind of retail partner or retailers that have essentially been the go-to place for people to shop for shoes, now tying up. What does this signal to you? What was your first reaction?
Yeah, Brad, retail is undergoing consolidation, so less is more. And when you do combine, the synergies can make for a better customer experience if you can save money and reinvest. So what we're seeing here is bigger can be better in scale. What we're also seeing is rationalization, but consolidation, M&A doesn't surprise me, in part because there's such rapid transformation in both consumers and the products that are working, and also new tests on heritage brands in terms of new entrants. So I'm not surprised. It's always fascinating what's happening. Another company we follow is Mytheresa on the luxury space, and this platform of Net-a-Porter plus Mytheresa. Big question for these deals always is integration, synergies, and dis-synergies, and culture and people, and how that will work in the long run. Retail's at a crossroads a bit. Everybody wants better in-store experiences.
Right.
Main problem here, traffic and being special, and so we'll watch it.
Yeah, we certainly will. And of course, we'll be watching that proposed deregulation from the White House, because that's certainly going to come up as Dick's moves to acquire Foot Locker here. Oliver, thank you so much for joining us this morning. Great to get your insights as always. Quick programming note, Walmart CFO John David Rainey, he'll join us in the 10 a.m. hour to discuss the latest quarter. You won't want to miss that conversation. Let's get to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. I want to go back to the NASDAQ because you were just saying how we were just up 6 days and it looks like we're snapping that streak. And this is what today is looking like, a nice gap down. Well, not so nice. But let's take a look at the last 10 days and we can see we've had a really nice rally from the middle of last week. That's up 7.5%. We've seen the S&P 500 here up year to date, finally turned positive. Looks like it's just slightly negative, but it was positive briefly yesterday. But this all happened, and I'm pointing to this rally right there, very quickly. And so it would be normal within history to take a little bit of a pause here. And we've got the major indices, including the S&P 500, within 4 or 5% of record highs. And so that's what I'm thinking. And I'll continue that logic on, but I want to make a few pit stops first. First, checking in on the 10-year Treasury T-note. Let's dial this back to an intraday view. We can see we were punching up. Let's actually make it 2 days because yesterday we were punching above 4.5%. That has big implications, that big round number for equities, for risk markets. But you can see we've come back down again. And I'm going to be doing a deeper dive on the 30-year because it was almost approaching 5%. This has important implications for stocks throughout history. And then just jumping over to the VIX real quickly, and this is kind of in line with what I was saying, the markets might be ready for a pause. This is a 2-day view. And yesterday when the markets were up, stocks were up, we saw the VIX up as well. And that's a little bit of a warning sign. We're seeing it just a little bit positive today. So incremental evidence to and towards that thesis. Now let's check out the sector action. We got, well, utilities and real estate are leading here, but let me just show you what's happened over the last month. We got tech up 16%, consumer discretionary, that's Tesla, and Amazon up 13%. Industrials is next, up about 12%. And these guys are just a little bit overbought as well. Bespoke is coming out with analysis that says these stocks that are in these ETFs, so many are above their 50-day moving average, approaching and actually exceeding 90%, that it would be historically normal for them to pause right here. And that's just a kind of a continuing theme that I'm seeing in the markets today. So I'm going to put this back on an intraday view, and you can see actually everything is in the red right now. Google was the last holdout. It was green in the pre-market, but the Mag 7 definitely pulling back today, led by Amazon and Tesla. And let me get to something I've been watching among my leaders here. Solar has had a nice run over the last few weeks, and you can see this is a 5-day look of all my market leaders. TAN is a solar ETF up 14%, and it's actually up 35% off of its lows. So this is a year-to-date chart. You can see the lows right there in early April. That's when everything else bottomed, up 35% or so since then. What I really like is a longer term. It is just nicely breaking out of a longer term trend channel. I didn't draw that precisely, but it's in the making right now. And if you're wondering, can the solar fly under a Trump presidency? Well, it happened under the first one for various periods of time. So sometimes these trades are head scratchers, but nevertheless, we pay attention to price action. I want to close with crude oil. Back to an intraday view. It is trading to the downside. In fact, it is leading the commodity complex down right now. Let's get back to a 5-day chart there, and we can see it was heading down from its highs over the last few days, bouncing around here. But this is the biggest drop in 2 weeks. Kind of important because I've seen crude oil trying to establish a bottom right here. It looked like we might have a W bottom, but this is just one big consolidation. And the next directional move could have important implications for the global demand picture with respect to supply chains and everything else we're watching right now. Back to you, Brad.
Jared, thanks so much. Great way to tee up today's trading activity. As we head to break, we're checking in on shares of UnitedHealth plunging 16% at the market open on the report from the Wall Street Journal of a probe into its Medicare business here. We're taking a look at shares, as we mentioned, down 14%, and in that Journal report ultimately saying the investigation adds to other government inquiries into UnitedHealth, including potential antitrust violations. They're also facing pressure from these investigations, stock price decline, recent CEO change, as well as the financials that they had to come out earlier this week and update and ultimately revise lower here with some of the 2025 performance outlook that they had established in December 2024. Net earnings of $24.65 a share, $25.15 a share on the top end, and adjusted earnings of $26 to $26.50 per share. Talking about heightened care activity indications within their Medicare Advantage business that became more visible as the business closed for them. So ultimately, the revisions, addition, of course, with the CEO changeover, and then additionally now in this DOJ probe reported by the Wall Street Journal, shares taking a massive hit over the course of this week. We'll continue to track that, plus many more moves ahead on Morning Brief.
Deere trimming the lower end of its annual profit forecast due to none else than tariff uncertainty. Still, the agricultural and construction equipment maker topping second quarter expectations. The shares up over 4%. Joining us now, Michael Schlisky, D.A. Davidson Equity Research Managing Director. Great to have you on, Michael. It's interesting. It seems like the worst being avoided for this stock in terms of the guidance is enough to lift it this morning. What's your reaction?
Yeah, that's exactly right. Sure, they did take down the low end of the full year range for their net income. At the same time, they did maintain their operating cash flow outlook, didn't change that at all. And most of the downside, there's some in different segments, but most of it appears to be the smaller end of the spectrum of some of the smaller ag equipment items and not the large tractors and the combines. That seems mostly unchanged.
And so as you're looking through these results, I mean, we're taking a look at some significant declines in net sales and revenue, at least year over year. So how are you kind of assessing what the business opportunities look like from this point, and if that makes Deere investable or not?
Well, I would say that there are two things going on there for the pretty big downturn on the top line. First of all, Deere is still trying to reduce inventories in the distribution channel to make sure that when things do get better or get at least flatten out at the bottom, that their inventories are fresh, they're clean, they're not going to be discounted heavily. And so they are underperforming the retail sales. So in other words, they are building a lot less than they're selling in the actual dealerships. So that's the first part of it. If you look at what dealership activity actually took place in the second quarter, it shows that sales were actually down only about 7.5%. So to have their numbers down 15-20% for the year, we're clearly trying to clear out inventory. The second thing beyond that's going to come down to the current crop condition. Can the weather hold up? It was just kind of put in the ground in the Corn Belt. Will we see a drought? Will we see a flood, et cetera? Those kinds of issues are going to be very important through the end of August.
Yeah, and I can't believe we haven't talked about the tariff impact on those crops at all as well, because this is something when we talk to farmers on our program that they cite as a huge concern for them. And of course, it's a concern for income of a company like Deere, relying on farmers buying equipment from them. But the company did say in these results that they took into account any potential tariff impact. Do you believe them?
Yes. In fact, the impact is a little bit less than you might think. Everyone has to eat, and that's globally. Doesn't matter what country you're in. And so while, yes, tariffs could affect the farmers here in the United States, and that would be a tough thing to bear, somebody else in a different region is going to benefit. Their crops are going to be in more demand because folks can't starve. And so it sounds like if, let's say, China starts to import less U.S. soybeans, they'll just get more from South America. Deere sells plenty of tractors there. I'll have no issue with growth in that region instead. So in that respect, ag is a little bit different than most other end markets out there.
Michael, as I'm taking a look at some of the industry outlook and across geographies right now, two areas really stick out. And it's South America. They're anticipating that is essentially going to be flat in their unit sales, and then also flat unit sales in Asia. What do you take away from that, knowing how much they want to invest further into their relationships and their pipeline in South America? I believe they have their Investor Day in Brazil coming forward in June. And then additionally in Asia, where as of right now, in the middle of a geopolitical tension-filled moment and environment, is there a headwind to selling U.S.-born equipment into that region and some of the mindshare sentiment?
Yeah, sure. In South America, especially in Brazil, you pretty much have to make the machine in the same place in which you sell it. So in Brazil, Deere has a full manufacturing footprint there, and they sell mostly within South America. It's the most rapid growing area of the world as far as crop acreage for corn, for soybeans, et cetera. They're even adding in an additional season per year if they can of additional crops. So it's important that Deere grow there. As I mentioned, some of the uncertainties from a tariff perspective between the U.S. and China, two major growers and buyers of the crop. The third place is Brazil, and they very well may end up being a medium to long-term winner here. As far as Asia goes, they like to oftentimes go by the strong brand name. There's not a stronger brand name in ag than Deere. So I'm not surprised to see that, Deere's trying to consolidate market share and grow in these faster growing areas.
What's going to happen to this stock the next time the president makes it a talking point? Obviously, it came up a lot on the campaign trail. How concerned are you about that happening again and the volatility that may cause in the price action?
Yeah, I mean, that's going to be interesting. When you look back, what's happened in the past when you had tariffs back in 2017, 2018, farmers got supported by the USDA in the end. There were some special payments made to help support net incomes, mostly to kind of shore up balance sheets. They probably won't be used to go down to the store and buy your latest tractor, but it does help farmers. It seems like the government, both parties, have a strong interest in keeping farming viable, thriving here in the U.S. It's a little bit about differences in the policy as to how they get there, but it does seem like there's pretty strong support. And if things get truly bad, there could be additional support payments.
Michael, good to see you this morning. Thanks for breaking down Deere's results.
Thanks, Madison. Thanks, Brad.
All your markets action ahead. Stay tuned. You're watching Morning Brief. The energy sector taking a hit this morning as oil prices fall on expectations the U.S. and Iran could soon reach a nuclear deal. President Trump, speaking from Qatar Thursday, says the U.S. is, quote, getting close to a deal after a recent round of negotiations. Here with more, we've got Yahoo Finance senior reporter Inez Ferre. Inez, what do we know?
Yeah, Brad, and why we're seeing oil down today, strictly because of this, because of that possibility that you may see soon a deal between the U.S. And Iran when it comes to their nuclear program. They've been now in their fourth round of negotiations, and Axios had reported that on Sunday that the U.S. presented a plan to Iran. An Iranian official, according to NBC, had said that they would be willing to agree to the deal to never make a nuclear weapon and some other aspects of that deal as well, as long as economic sanctions were lifted. So if this happens, look, Iran is a big oil exporter and producer. They produce more than 3 million barrels of oil per day. Some analysts are saying that if the deal goes through, that you could see about 1 million more barrels being exported from Iran. So you would move into an oversupply situation. And if we take a look at crude futures, you're looking at Brent crude that's down 14% year to date. It had a terrible April. OPEC Plus has agreed to increase supply. President Trump really wants the price of oil to come down. And we're seeing analysts that are emphasizing this. And Goldman Sachs is forecasting that you haven't seen oil go down enough, that you are going to see oil averaging around $60 for Brent for the rest of 2025, and WTI at around $56 per barrel.
Inez, thank you so much. That's going to do it for Morning Brief. Joining me in the next hour for more analysis on Catalyst. Stick around.